Welcome to our regular 6-minute strategy from me, Guy Monson. This week, global markets are being pulled higher by two powerful forces: oil prices and the SpaceX IPO. In the Middle East, a ceasefire with Iran has raised fears of a wider conflict and has helped calm energy markets. While the Strait of Hormuz is unlikely to return to normal overnight, investors are increasingly confident that disruption of global oil supplies can be contained. We continue to expect Brent crude to trade in the $80 to $90 range through to year end. At the same time, America is experiencing one of the most extraordinary periods of capital raising in its history. Record-breaking IPOs led by SpaceX are attracting enormous investor demand and reinforcing confidence in the longer-term growth potential of artificial intelligence. But beneath the excitement, important questions remain. SpaceX has come to a market at a valuation that assumes years of future successes, while anticipated listings from Anthropic and ChatGPT are expected to command similarly ambitious prices, despite remaining loss-making businesses. So can markets absorb this flood of new supply? And how will investors react if the Iranian ceasefire were to break down? That's what we'll explore together in today's 6-minute strategy. Let's begin by looking at our regular review of global equity and asset class performance since January 2025. And you can see there in the left-hand panel that silver line up 29%, the astonishing rally in global equities following the lows of the Trump liberation speech back in 2025. If you put a quality overlay onto this, you look for companies with a higher margin, stronger balance sheet. That took the return down to 20%. If you looked at the ultimately defensive portfolio, that's companies who have raised their dividend every year for the past 10 years, you're generating just 11% returns. So a hugely focused and cyclical market, as we saw again in the last 6 weeks with this astonishing rally in semiconductor stocks. On the right-hand side, I've just shown the performance of assets since the beginning of the war at the end of February. Equities up 8%, that's before the ceasefire is actually in place. Dollar relatively stable. Gold falling sharply but beginning to rally. Remember though, we had a big run-up in gold in 2025 and early 2026. So what are the key issues for markets today? Well, of course, the most important is the contours of this ceasefire that Iran and the US seem to have achieved. We put an 85% probability on this and expect Brent to stay somewhere around $89 to $90 going forward to the end of the year. That's even with an unlocking of the straits, still pressure from countries to rebuild their reserves. We should see a resumption of shipping of energy, of bulk and bulk commodities. The mine clearing will take a few months, so the initial passage will be through narrower channels. And of course, you've got to rebuild some of the facilities damaged by Iranian bombs. Now, the news here is a little bit more encouraging. Today, we heard the Ras Laffan gas facility, one of the biggest in the world in Qatar, should be back to 50% capacity in 1 month and 80% in 2 months. Now, this could all go wrong. We could have an escalation again. We put that as a 15% probability. What might trigger it? Well, Israel disrupts ceasefire with further campaigns in Lebanon. We could look at limited progress on nuclear disarmament, or the Americans could backtrack on releasing frozen assets, or the Iranians on turning the Straits of Hormuz. We've got a $120 oil price baked into that if that scenario comes about. But we're firmly holding to that 85% probability of the ceasefire holding. What's the other big issue in markets? Well, of course, there's this huge demand for equity as this massive investment program in data centers across the US and across the world. And Morgan Stanley estimate that in 2027 alone, there'll be $1 trillion worth of capex just from those 4 big hyperscalers and Oracle. That, by comparison, is roughly the same level as the American military budget today. Extraordinary numbers. That's going to put huge pressure on cash flows. So, thanks to our friends at Empirical Research, they've charted the free cash flow margins of Microsoft, Alphabet, Amazon, Meta, and Oracle from 2024 through to end 2026. And you can see that with the exception of Microsoft, cash flows just plunge to either zero or net negative, requiring, of course, big funding requirements. For someone like Oracle that doesn't have that lovely cash flow rich flows from the internet business, you're looking at a huge funding requirement. So how's this going to be achieved? Well, we've got, of course, the SpaceX IPO, the Anthropic IPO due, and the OpenAI IPO due all later in this year. Now, the indicated prices they'll be going for and the actual price for SpaceX are price to sales ratios that really are ahead of everything we've seen right back to 1980, with the exception at the eve of the internet boom and subsequent correction back in 1999. So we're asking a lot of these companies with these valuations, they've got to see repeated successes to justify them, and that does put some risk into IPO positions today. What's it mean for the wider US equity issuance on the next slide? Well, you can see that for the last 20 years, the equity market has actually been shrinking. Share buybacks plus companies taken private plus M&A have actually been greater than any equity issuance that's been put out in the underlying market. That's been hugely supportive of earnings. But as you can see, those numbers are falling away, and if I'm right about the fundraising requirements needed for these data centers going forward, that issuance could turn positive. That's a very different world for investors to the one where every year their earnings were flattered by a smaller underlying market. So let's wrap up. Well, first of all, the US-Iran ceasefire will likely trigger lower oil prices and should cap inflation. That's good for the economy and good for the rating of markets. Secondly, equity valuations in this AI-linked world are high, and there's going to be a real scramble for capital. Third, US equity net issuance will reappear for the first time in 20 years, and that's a different backdrop for investing and less flattered by underlying share buybacks, which amplify earnings. Fourthly and finally, there look to be some opportunities appearing in the unloved areas of the market, particularly in quality and income stocks. Well, I hope that all helps you. I hope it ties together the war, the IPO and the valuations as the challenges we've got to face in the years ahead, to an equity market that's otherwise very well supported by the potential productivity increases of AI in the long term. Thank you.